Every time I say that Donald Trump is going to cause an intentional recession to make the rich richer, people come into my comments and they go, oh, you're fear-mongering, you're trying to scare people, that's not really going to happen, Trump would never allow that to happen. Well, take a look at this. Dow tumbles 900 points as sell-off intensifies following Trump's confirmation of tariffs on Mexico and Canada. This means that the stuff we buy is about to get more expensive. Add in government layoffs that could be over 200,000 people once this is all said and done, many of those people of whom will go on unemployment. We could see local economies, like right here where I live in Washington, D.C., and families get absolutely devastated by this. Now, this is from CNN. It says, may not dent the overall economy. However, I disagree, because when you look at the cumulative effect of things, yeah, this alone might not cause a recession. But higher prices plus layoffs rolls into a potential recession. So this is how I'm protecting myself as an investor for more than 20 years. I'm going to show you something. You're going to be familiar with this if you're a regular here on my channel. I got to figure out how to close this drawer. This right here is my original recession wish list from November 2008. And a lot of people, big name people, said, oh, the markets will never recover from this, but I knew better. And look at what this guy says. Chief economist says whether the stock market can survive remains to be seen. Oh, come on. Stock market's going to be fine long term. Short term, absolutely. There's going to be potential chaos. Markets could tumble. We could see a big recession, maybe even a depression, which, you know, who would love to see something like that? Huh? Billionaires, housing developers, companies like Vanguard and BlackRock who could buy up all the foreclosures and all the assets on the cheap when the markets tank. It's almost like this is being done intentionally. You can hear the trash guys outside, right? Oh, well, now they stopped. Number one, get you a wish list. This is mine from 2008. Now, a lot of people are going to run to the comments and go, show us your wish list for today. I don't have one because I'm already diversified, which is another word that you can't say anymore. But when it comes to the stock market, diversity is key. Diversity insulates your portfolio. Now, there's a difference between being diversified and being over-diversified. Over-diversified means I'm going to buy all these different companies and I'm going to have so many companies, but then you spread yourself out too thin. So number one is to be diversified. Number two is defensive stocks, healthcare, staples, utilities, like your electric bill, like Pepsi, who owns Doritos, stuff like Johnson & Johnson, Procter & Gamble. You're going to need these things no matter what's going on in the world. When stocks drop, bonds usually go up. This is because they're backed by the US government and people seem to like safer investments during rough times. So sometimes people opt to have more bonds in their portfolio. I personally don't, but you got to do what's best for you. Dividend stocks tend to be insulated. They have a long track record of riding out economic downturns and recessions, and throughout all of that, still managing to increase their dividends through all times. One utility ETF to consider would be XLU. A dividend fund to consider would be SCHD. If the data shows that we actually are heading into a recession, some investors prefer to sit on a little bit more cash, or if you're Warren Buffett, which you ain't, a lot more cash. I'm not the biggest fan of this idea because a lot of new investors who are focusing on 30 years down the road and they're doing, $200 or $300 a month into their S&P 500 index fund suddenly stop investing. Don't do that. Just keep investing. And if markets drop really hard, then you can go in and you can buy a little bit more than usual if you're fortunate enough to be able to do so. Remember, recessions are humongous wealth creators. Take a look at this wish list here. A lot of these companies have skyrocketed since 2008. If you can seize the opportunity, it's a huge wealth creator. Of course, then you're going to get guys like this saying, I don't know if the markets can survive this. Why would they be trying to tell you that? Maybe they want you to sell more of your assets so they can buy them on the cheap? High risk and heavily speculative investments, like stuff you hear about on TikTok where some guy goes, yeah, this could 10x or 100x in a week. No, those are super high risk. And in recessions, those are usually the ones that get crushed first. It doesn't mean that these are bad and that you shouldn't invest in them at all, but risk management is key. You shouldn't be thinking, I wonder how much I can make. You should be asking, I wonder how much I can lose, and then go from there. In times of economic uncertainty, a lot of investors also like to look at stuff like gold or silver, which they view as a hedge against inflation, which, let me tell you something, we're going to see a lot of. Almost everything that we buy comes from Canada, Mexico, or China. And what has Trump just done? He's imposed tariffs on Canada and Mexico, along with China, I think earlier in the week. Recessions are really, really scary for new investors. But for experienced investors, recessions are wealth creators. So I'm personally sitting on a little bit more cash than I usually do. When I look at a day like this where the markets are down almost 800 or 900 points, I did a little bit of buying, but not so much because I don't want to throw away all of my money. I don't want to buy everything here in the event that stuff drops further. This is okay for me because I'm already well diversified. Like I said earlier, if you're $200 or $300 a month into an index fund or something, don't change what you're doing. Just keep doing what you're doing. But for diversified, heavily invested investors such as myself, I'm already happy with what I got. I'm just looking for deals. Hey, this one's down 5-10% today. This one's down 10% today. Oh, maybe I'll buy a couple more shares here. Not as much as I would normally buy. So in strong markets and strong economies, maybe I'm buying 100 shares at a time. In times like today, I'm buying 5, 10, 25 shares, maybe 50 shares, depending on the price of the stock. I know this is a longer video, but I know a lot of people are stressing out about this, so I just wanted to come out here, remind everyone to cool down. Everything is going to be okay long term. Even though it seems like things are getting pretty scary out there and markets could take a hit, prices could get driven way higher for what we're buying. As long as you're a long-term investor focusing on the long term, it's going to be okay. All right, smash the follow, save this video so you can come back in a month and tell me I was wrong. Thanks for watching. See you later.